Hi, Assalamualaikum. So my name is Farah Amira Mitiraban. My match number is 10740. So our group members will be present about the hedging accounting. So me as the first presenter, we will see the introduction of hedging accounting first. So what is hedging accounting, or what is hedging? According to MFRS 9, a hedging is the making of investment or acquiring some derivative or non-derivative instruments in order to offset the potential loss or gains that may be incurred on the sometime items as a result of the particular risk. So, in this slide, there is an example whereby people decide to hedge. They are ensuring that themselves against the events impact to the finances. So this does not prevent all the negative events from happening, but something does happen that you are properly hedged, the impact of the event will be reduced. So let's say another example, if you have a home in the prone area, so of course you want to protect your asset, right? So to protect or to hedge it, you usually people will taking insurance policy of their home, of their house. So in this situation, we cannot prevent the flood from happening, but we can mitigate the danger if the flood occurs. So in this insurance policy, the monthly payment that we add up, and if the flood never come, the policy holder will receive the no payout. So let's take a look another example of hedging. So another example in hedging, so we can see this example. I adapt from IFRS box website. So in this situation, that imagine that your company normally operates in USD, but recently your company is decide to spread out your business to Europe and made a contract to sell the some goods to European customer at, let's say, at 20 million euro with delivery in 9 months. So however, your company afraid that due to movement in foreign currency risk, it will become significantly less USD after 9 months. Therefore, your company will get enter into the contract to offset the foreign currency contract with the bank for 20 million euro for some fixed rate at 9 months. So this means that your company will offset the foreign currency to reduce the potential risk that may happen due to the foreign currency movement in 9 months later in the future. So in this example, what is the hedging? There are 3 types, which is the hedge risk, the foreign currency risk. The hedge item is the highly probable forecast transactions, which is the sale happens, and the last one is the hedging instrument, whereby it's foreign currency forward contract to sell the EUR to a fixed rate at a fixed date. So in this slide, we will discuss why business do hedging. So of course, the first one is to lowering the tax liability. Usually company can lower their tax liability or the expected tax by purchasing insurance for their company. The second one is the company want to improve year-over-year reporting, whereby the companies may report to the analyst on a year-over-year or constant currency basis that can align their hedge strategy with their year-to-year over reporting. The third one is to increase the credit worthiness, whereby bank can extend their credit to companies based on their credit worthiness. So if the company has stable P&L, it may increase the credit worthiness to the bank. The last one is to reduce the long-term risk, whereby it is important to use the proper strategy when hedging derivative, because the company can increase the chance of the to gain an amazing return in the future. So in this slide, we will focus more about the hedging accounting concept. So what is hedging accounting? A hedge accounting means designating one or more hedging instruments so that the change in the fair value offsets the change in the fair value or the change in the cash flow of the hedge item. So I highlight two situations whereby the company without hedge accounting and the hedge accounting. So let's take a look the first one, which is the without hedge accounting. So if the company did not use any hedge accounting, any gain or loss that resulting from the change in the fair value of the foreign currency forward must be recognized in the profit or loss account. But if the company use hedge accounting, the hedge would be recognized as cash flow hedge, meaning that the company need to recognize the part or the full foreign currency forward directly to equity or other comprehensive income account. So in this slide, there is an example whereby if the investor purchase a security that comprise a high level of the risk, they may accompany the purchase with the opposing items such as option or the future contract as a hedge for their company in the future to reduce their potential loss. So in this slide, we discuss about the derivative in hedging accounting. So what is derivative? The derivative is the financial security with a value that is reliant upon or derived from an underlying assets or group of assets like stocks, indices, commodities, exchange rates, currency, and more. Derivative deals with an agreement whereby there are two parties, a buyer and a seller, agrees to buy or sell at pre-decided price and at the future date. So derivative is used as the risk management tool that allows an investor to transfer the risk attached with the underlying asset to the party who willing to take it. So this is an example or types of derivative commonly used in hedging accounting. The first one is future contract, the second one is forward contract, the third one is option, and the last one is swap. So we will discuss the four types of derivative more in the next slide. So the first types of derivative that we will discuss is forward contract. So a forward contract is a type of hedging mechanism where there are two parties involved. It is an agreement that is done on the spot between the two parties regarding buying and selling an asset, but the action will be required to be made in the future. So one party will be buy and the other party will sell irrespective of the current market price and the condition of the stock market on the specific future date. So the other party will be bound to buy the asset if it is not profitable to do, since they are bound by the contract, and the second party will be riskless in his entire transactions. This is an example mechanism to hedge the risk at a certain level. So let's take a look the example of forward contract. So assume that the green one is the farmer, whereby the farmer has the 2 million bushel of corn and want to sell the bushel of corn 6 months from now, but he concerns about the potential decline of the price of the corn. What he do? He will enter the contract to the financial institution to sell the 2 million bushel of corn at $4.3 per bushel in 6 months on the cash basis. So in the 6 months, the spot price rate corn has three possibilities, which is if the price is exactly $4.3 per bushel, there is no money owned by the producer or the financial institution to each other and the contract will be closed. But if the price is higher than the contract price, let's say $5 per bushel, the producer owes the institution 1.4 million, or the difference between the current spot price and the contracted spot rate of $4.3. But if the price of the bushel is lower than the contract price, let's say $3.5 per bushel, the financial institution will pay the producer 1.6 million, or the difference between the contracted price at $4.3 and the current spot price. So move to the next point. The second types of derivative is swaps. Swap is an agreement to exchange the financial asset at a fixed price and date. Swaps are agreements between two parties who exchange the currency. At the initial moment, they usually send back the small amount as the interest, and finally they return back the initial amount. So now let's take a look at an example for swaps. So a US firm has receivable in euro from a Belgian buyer, so it is looking for euro-denominated liability to hedge the receivable. On the other hand, a Belgian firm exports to US and has US dollar-denominated receivable, and it needs US dollar liability to hedge the receivable in US dollar. The two firms agrees that US firm borrow, let's say, $100,000 at 11%. Belgian firms borrow $100,000 divided by 0.6 per dollar equal to 166,667 euro at 10%. US firm receive euro from the buyer and give it to the Belgian firm so that the Belgian firm can repay the euro denominated loan. The Belgian firm receive US dollar from the buyer and give it to US firm so that US firm can repay the US dollar denominated loan. Both firms lock in the current spot rate or the future payment by the swapping receivable. Okay, this is the third type of derivative that commonly used in hedging accounting, which is options. So options is an agreement between the two parties to buy or to sell an asset at the predetermined future date for the specific price. This option contract is similar with the forward contract and future contract, whereby the key difference between them, there is no obligation that need to be fulfilled by them, meaning the both parties. So there are two types of options, which is call option and put options. Call option is the financial contract whereby to give the buyer the right but not the obligation to buy a stock, bond, commodities or other asset or instrument at a specific price within the specific time period. So the second one is put option, a contract whereby giving the owner the right but not the obligation to sell or sell short for the specific amount of an underlying security at the predetermined price within the specific time period. And this is an example. So assume that an investor buy 100 share of XYZ share at $100. So the investor is bullish on the stock, but he also nervous that the stock may drop in the future. So to hedge or to overcome this from happen, the investor buy the put options for $1 per share. So the option will expire in 3 months, then has a strike price of $90. So this option give the investor right to sell the XYZ share at $90 at any time for the next 3 months. So assume that in the next 3 months XYZ is trading at $110. So the investor will not exercise his put options, but he will gain $10 from the increase the stock price from $100 to $110. So however, he lost the premium of $1 per share that he paid for the put option. Therefore, his total gain loss will be $9 per share. But if let's say the XYZ is trading at $50 per in the 3 months, so if this happen, the investor will would access his put option and will be able to sell the XYZ share at $90 per share rather than $50. So by doing this, he only lost $11 per share rather than $50 per share. So this option saved the investor from the substantial loss in the future. Last type of derivative that commonly used in hedging accounting is the future contract. A future contract is the standardized legal agreement to buy or sell an asset at the predetermined price at a specific time in the future. At this specific time, the buyer must purchase the asset and the seller must sell the underlying asset at the agreed upon price regardless of the current market price and the expiration date of the contract. So underlying the asset for the future, contracts can be commodities such as wheat, crude oil, natural gas, and corn or other financial instruments. This is the example for future contract. So let's say there is a seller and the buyer. So this seller wants to sell a December corn for the future contract at $4.5 per bushel. So the contract buyer is purchasing this December corn uh, contract at the $4.5 per barrel. So this seller is locked $4.5 selling price for 5,000 barrel of his corn, and he agrees to deliver to the buyer in the December. While the buyer also is locking $4.5 price for the 5,000 barrel of corn, and she agreed that she will receive the corn in December. So at this point we can see that there is no physical movement of the corn, but the seller and the buyer have simply made an agreement for the future transaction to buy the corn.
Okay, now I will show the accounting for derivative financial instrument for a forward contract, future contract, and option contract. Okay, for forward contract, the journal entry for forward contract is debit forward contract asset and credit gain on forward contract, or debit loss on forward contract, credit forward contract liability. Okay, next is for a future contract. The journal entries for future contract is debit cash, credit gain on future contract, or debit loss on futures contract, and credit cash. Okay, lastly, option contract. Okay, the journal entry for option contract is a debit option contract, credit gain on future contract, or debit loss on futures contract, and credit option contract. Okay, next is a classification of financial instrument. Okay, according to MFRS 9, MFRS 9 classifies financial asset based on two characteristics, which is first, the entity business model for managing the financial asset. Second, the contractual cash flow characteristic of the financial asset. Okay, a financial asset shall be measured at amortized cost if both of the following conditions are met. Okay, the first condition is the financial asset is held within a business model whose objective is to hold a financial asset in order to collect contractual cash flow. Okay, the second condition is the contractual terms of the financial asset give rise on specified dates to cash flows that are solely payment of principal and interest on the principal amount outstanding. Okay, next, a financial asset shall be measured at fair value through other comprehensive income if both of the following conditions are met. Okay, the first condition is the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial asset. Okay, the second condition is the contractual terms of the financial asset give rise on specific dates to cash flow. There are solely payments of principal and interest on the principal amount outstanding. Okay, last but not least, all other financial assets fall in this category. The category is fair value through profit or loss. Derivative financial assets are automatically classified at fair value through profit or loss. However, an entity may make an irrevocable election at initial recognition for particular investment in equity instrument that would otherwise be measured at fair value through profit or loss to present subsequent changes in fair value in other comprehensive income. Okay, in the right side of the slide, classification of financial asset, it shows that uh, the simple way to understand how to categorize the financial asset. Okay, now what is hedging arrangement? Okay, hedging arrangement is a hedge, swap, option, or forward sale or purchase, or other contract, or similar arrangement, including any obligation to purchase or sell any commodity or security at a future date for a specific price, which is entered into to reduce or eliminate or otherwise to protect against the risk of fluctuation in prices or rates, including interest rate, foreign exchange rate, commodity prices, and securities prices. Okay, now what we can see in the slide is hedging documentation. What is the content in the hedging documentation? Okay, what we can see from the slide, the content of hedging documentation is the company need to prepare the risk management objective, hedging strategy, hedging instrument, hedge item, nature of risk hedge, and hedge effectiveness. Okay, company also need to avoid the information of their documentation which is too general, and they put and company put the insufficient details in their documentation. Okay, next, company need to avoid a copy of MFRS 9 text, which is they just copy the text in the MFRS 9 into their documentation. The company need to avoid that. Okay, last but not least, company need to avoid prepare the hedging documentation after the inception. Okay, now I will talk about hedge item. Okay, hedge item consists of a recognized asset or liability, an unrecognized firm commitment, a forecast transaction, or net investment in a foreign operation. Okay, the hedge item can be a single item and a group of items. Okay, what is a single item? Okay, a single item is a loan denominated in a foreign currency that is exposed to currency risk. Okay, next, a group of item is a group that share the same risk. For example, a portfolio of bonds that share similar interest rate risk. Hedging instrument. Hedging instrument consists of a derivative measured at fair value through profit or loss, a designated non-derivative financial asset or non-derivative financial liability which fair value or cash flows are expected to offset changes in the fair value or cash flows of a designated hedge item. Okay, the examples of hedging instrument is interest rate, swap, future contract, forward contract, and option. Okay, for example, international companies that buy and sell products in currencies other than their functional currency are exposed to foreign exchange risk, as the fluctuation in the exchange rate can have a negative impact on their profit margins. So, To minimize that risk, these companies can purchase financial product to secure a specific exchange rate on a future date.
Thank you, my friends. So, I, Siti Bakis binti Mama Arifin, would like to present the types of hedging. So, as we all know, we have three types of hedging, which is fair value hedging, cash flow hedging, and net investment in foreign operations. Okay, move to the next slide. Okay, first for the fair value method. As we all know, the fair value hedge is hedge of the exposure to changes in the fair value that is attributable to a particular risk with all or a component of, which is recognized asset or liability or unrecognized firm commitment. For example, a binding agreement for a exchange of a specified quantity resources at a specified price on a specified future date, and can result in either profit or loss. First, a fair value hedge relates to a fixed value item. According to MFRS 9, prescribed that as long as a fair value hedge meets the qualifier criteria for hedge accounting, the hedging relationship should be accounted for as follows. First, the gain or loss on the hedging instrument shall be recognized in P&L or profit or loss. Second, the hedging gains or loss on the hedge item shall adjust the carry amount of the hedge item, if applicable, and be recognized in P&L also. Okay, next slide. Okay, we have three steps for fair value hedges. First, we should determine the value for both the hedge item and the hedging instrument used on the date of reporting financial statement. Second, if there is a change in the fair value of the hedge instrument, recognize the profit or loss in the books of accounts. And lastly, recognize the hedging gain or loss on the hedge item in its carry amount. Okay, next. So this is the example for fair value hedging in terms of commodity or inventory. So, Tepeco Incorporated is a company engaged in the commodity tradings. The company recently obtained $5 million short-term borrowing, which is secured by the company's inventory of 1,000 tons of copper, which is purchased at a cost of $5.2 million. The bank has obligated Tepeco Incorporated to provide additional collateral in event the value of copper inventories falls below $5 million. On 1st January 2015, Tepeco Incorporated sold the inventories forward by entering into a 12-month future contract at a price of the $5,200 per ton. On 30th June 2015, example, the financial year end of Tepeco Incorporated price copper fall into $4,900 per ton. $4,900 per ton. So first, we should identify the hedge instrument and generalize the transaction. Okay, next. Okay, this is the solution. So first, we should identify the hedge instrument. So hedge instrument is the instrument whose fair value is shielded using the hedging strategy. In this case, it is the copper inventory held by Tepeco Incorporated. And the second is hedging instrument, on the other hand, is the derivative instrument which mitigate the fair value changes of hedge instrument by reversely mimicking its fair value movement. So this is the adjustment. On 30 June 2015, the fair value of the corporate inventories held for trading shall be adjusted as follow. So we should debit the profit and loss, which is $300,000, and credit inventories, and we should $5.2 million minus 4,900 times by 1 million times. So we can get the $300,000. Okay, next. So continue. The loss of inventory shall be offset by corresponding gain on the forward transaction. Since the forward transaction entitled Tobacco Incorporated to sell copper at 5,200 per ton, $5,200 per ton, even though the market price is $4,900 per ton. It represents at a $300 gain per ton, which translate into $300,000 gain on 1,000 tons. The fair value changes of the hedging instrument is recognized as follow. So debit derivative asset, which is $300,000, and credit profit and loss 1,000 times we should minus the $5,200 minus 4,900 and multiply by 1,000 times, and then we can get $300,000. Okay, next. Okay, so we go to the next method, next types of hedging, which is cash flow hedging accounting. So definition of the cash flow hedging accounting, as we should know, the hedge of the exposure to variability in cash flows to a particular risk associated to all or a component of recognized assets, liability, a highly probable forecast transaction, unrecognized firm commitment that could affect profit and loss. Next. Okay, so the purpose of the cash flow hedging accounting is first, against the risk of the changes in expected cash flow, and the second is to defer or postpone the gain or loss on the hedging instrument to a period or periods in which the hedge expected future cash flow will affect the profit and loss. Okay, next. Okay, example. Example is first, future cash flow on the forecast sale or purchases in the foreign country, and second is volatility in future cash flow might result from changes in interest rates, exchange rates, equity price, or commodity price. Next. Okay, how to account the cash flow of hedging instrument. Okay, cash flow of hedging accounting. So for the loss, we should the description first is loss on the hedging instrument effective portion. So we should debit other comprehensive income or cash flow hedge reserve, and credit statement of financial position, which is financial liabilities. And second is loss on the hedging instrument ineffective portion. So we should debit P&L, profit and loss, and credit also statement of financial position, which is financial liability. And next. Okay, for the gain, description is gain on the hedging instrument effective portion, same with the loss, but just change the gain and loss. So we should debit SOFP, which is statement of financial position, and which is financial asset, and debit other comprehensive income or cash flow hedge reserve. And the second is gain on the hedging instrument ineffective portion. So debit a statement of financial position, financial assets, and debit profit and loss. Next. Okay, for the steps, we have 5 steps. So step 1 is determine the gain or loss on the hedging instrument or recognized item and hedge item, expected of future gain or loss on unrecognized item at the reporting date. And step 2 is recalculate the effective date and ineffective portion of the gain or loss on the hedging instrument. Next. Step 3 is recognize the effective portion of the gain or loss on the hedging instrument in other comprehensive income. This item will be called cash flow hedge reserve in other comprehensive income. Step 4, recognize the ineffective portion of the gain or loss on the hedging instrument in profit and loss. And the lastly, which is step 5, is when the hedge expected future cash flows or hedge forecast transaction in the future affect the profit or loss, we should reclassification adjustment according to IAS 1. So next, okay, over or under hedging. So when happen for over hedging, which is effective portion to the other comprehensive income or ineffective to profit and loss, we should example, if gain or loss of the hedging instrument is more than expected loss or gain of the hedge item, so we call it over hedging. And for the hedging, under hedging, which is effective portion to other comprehensive income, which is gain or loss of the hedging instrument is smaller or lower the expected loss or gain of the hedge item. Okay. So we continue with the example. For valuing a cash flow hedging instrument results in a loss of the 10 million ringgit Malaysia. The portion that is determined to be an effective hedge for the hedge item is 8 million ringgit dollar. In this case, the recognition of the loss of the hedging instrument would be as follows. We should debit OCI because effective portion, as we can see that here also mentioned the effective hedge. So we debit OCI, which is 8 million, debit loss in PNL, ineffective portion 2 million, and credit hedging derivative, which is liability 10 million ringgit Malaysia. So next, so we should reclassification adjustment. Okay, for reclassification adjustment, amount that has been recognized in the OCI shall be reclassified from the OCI or equity to profit or loss as a reclassification adjustment in the same period or period where the transaction is recognized, which is depreciation expense or cost of sale, during which the hedge forecast transaction affects profit or loss. For example, when a forecast sale occurs, okay, if the hedge item results in recognition of assets, the gain or loss goes to adjust the carry amount of the assets. Next, hedge of currency risk of the firm commitment. I took this example from Talion Town Boots. Refer page 169, example 13. On 1st October 2008, it 3 ringgit convert to US dollar, $1, and buy an airplane at a price of US dollar 100 million and use forward contract for 6 months. Settlement in 31st March 2009. On 31st December 2008 financial year end, the price ringgit becomes going down. So 1 US dollar goes to 3 ringgit 50 cent. On 31st March 2009 settlement dates, the ringgit Malaysia going down, which is 3 ringgit 20 cents equal to 1 US dollar. Okay, next. Okay, this is example from the books. Okay, show the journal entry to record the above transaction, assuming the cash flow hedge accounting applies, and show the effect of hedge accounting if first, a basis adjustment is made, second, no basis adjustment is made. For this purpose, assume that the useful life of the airplanes is 10 years with a nil residual value. Okay, we can look here. On 1st October 2009, derivative contract is recognized in net value of the nil and designated as a hedge instrument. And 31st December 2020 S9 S8 is debit derivative asset, which is USD forward contract, your forward currency, which is 50 million ringgit Malaysia, and credit other corporate income, also 15 million ringgit Malaysia, which is this is to recognize a gain on the forward contract. On 31st March 2009, debit derivative asset, which is USD forward currency, credit other corporate income, to recognize 5 million ringgit Malaysia, and also debit 5 million ringgit Malaysia. And also debit cash, a USD account, and credit derivative asset, credit cash, which is 320, and credit derivative asset net 20 million ringgit Malaysia, and credit cash in RM account 300 million ringgit Malaysia. So this is to record settlement of the forward contract. Next is debit airplane property, which is property PPE, credit cash USD account, which is 320 million ringgit Malaysia, and debit cash 320 million ringgit Malaysia. This is to record purchase of the airplane at spot rate. When the basic adjustment is made, we can look here. Debit other corporate income, which is 20 million ringgit Malaysia, and credit airplane PPE 20 million ringgit Malaysia. To adjust, this is for adjustment amount of airplane. Okay, next. The lastly method, which is net investment hedge method. According to MFRS 121, the effects of changes in foreign exchange rates require that when the functional currency of the foreign operation differ from the parent currency, the financial statement of the foreign operation shall be translated to parent currency. And as according to MFRS 9, defines a net investment hedge of the foreign operations. The derivative product aim to minimize the impact of the foreign exchange fluctuation for the net investment in the foreign operation. Specific types of foreign currency cash flow hedge that used to eliminate or reduce the foreign currency exposure that arise from the entity net investment foreign operation. Okay, next. This is we extract from the standard. Hedge of the net investment in the foreign operation, including a hedge of a monetary item that is accounted for as part of the net investment, see in MFRS 121, shall be accounted for similarly to cash flow hedges. The portion of the gain or loss on the hedging instrument that is determined to be an effective date, if effective hedge, see paragraph 88, shall be recognized in other comprehensive income. The ineffective portion shall be recognized in profit and loss. The gain or loss on the hedging instrument relating to the effective portion of the hedge that has been recognized in other comprehensive income shall be reclassified from equity to profit or loss after reclassification adjustment. Okay, for you should see the MFRS 101, IAS 1 revised by IASB in 2007 in accordance with the paragraph 48 until 49 of the MFRS 121 on the disposal or partial disposal of the foreign operation. Okay, next. Hedging instrument. The hedging instrument of the hedge of net investment may be derivative instrument, which is two. First is currency forward and the second is currency swap. According to MFRS 9, allows a non-derivative instrument of the hedge of currency risk for loan and borrowing. For hedge to be effective, the hedging instrument must denominated in the same foreign currency as the functional currency of the designated net investment. Next, this is for recognition and treatment. So first, we should measure of the derivative. We should if have change in the fair value, so we should measurement of the derivative, and next effective portion. We should determine whether it is effective or ineffective portion. If effective portion, so we goes to other comprehensive income for recognition and also profit and loss. And for net investment in the foreign operation, first foreign currency gain or loss, so we goes to other comprehensive income for recognition and also profit and loss. If ineffective portion for change value, fair value, if the ineffective portion, we goes to profit and loss. So when the hedge item is disposed of, the cumulative gains or losses in the comprehensive income shall be recognized as part of the profit or loss on disposal. Next. Okay, example. Company W, whose functional currency in the US dollar, has a wholly owned Malaysia subsidiary. Subsidiary D, whose functional currency in ringgit Malaysia. The carrying value of the subsidiary D's net asset is 70 million ringgit Malaysia. Subsidiary D's net asset include the intercompany borrowing of 10 million ringgit Malaysia received from company W, which is not expected to be settled in the foreseeable future. So, the subsidiary D's management predict that it is highly probable that it will first earn a profit at least 8 million ringgit Malaysia and pay a dividend for 5 million to the 5 million ringgit Malaysia to a company W. Next. Okay. With investment hedging, company W can hedge up to 80 million of its net investment in subsidiary D at the date of the hedge designation. The 80 million ringgit Malaysia is represented by 70 million ringgit Malaysia of subsidiary D net asset, and the second is 10 million ringgit Malaysia intercompany loan. This loan could be designated as a hedge item because it is not expected to be settled in the foreseeable future, and therefore, in substance, forms part of a company W's net investment in subsidiary D. Next is subsidiary D forecast profit, which is 8 million ringgit Malaysia, and forecast intercompany dividend pay 5 million ringgit Malaysia cannot be included in the hedge item because they do not form part of company W existing net investment. The undeclared forecast intercompany dividend payment, which is 5 million ringgit Malaysia, do not qualify as hedge item because they will not affect reported net profit or loss, as the profit are earned. They increase the net investment and can be included in the hedge item. When dividend are paid, the amount covered in the net investment hedge might need to be reduced correspondingly. Okay, next, the benefit of the net investment hedge. First is, as we all know, to reduce the volatility in earning, result in number of additional. Okay, first is to reduce volatility. Besides that, we have another benefit, which is enterprise value. For any volatility is negatively perceived by investor. Creditworthiness, predictability in the future earnings is a positive factor in creditworthiness. Risk management, statements reflect better and more accurately how foreign currency risk is managed. And the lastly is executive compensation tied to performance. For example, measured based on quarterly earnings can incur unintended impact from earning volatility.
For the example from the annual report, I added annual report from Genting Plantations for the year ended 31st December 2019. So you can see in this consolidated financial statement, there is a financial derivative of asset which amount 101,041 in 2019 and 2,217 for 2018. Okay, in consolidated financial statement also, under the non-current liabilities, they also have derivative financial liabilities which amount 4,184 for year 2019, and for the current liabilities, they also have derivative financial liabilities at the amount 33,544. So let's see the notes to the account to see what inside this. In the notes account number 39, under the non-current designated as cash flow hedge, they mention here that there is an interest rate swap 4,184 for 2019, and under current, the interest rate swap is 3,555. There is a forward foreign currency exchange contract 1,141 and commodity future contracts to 29,989. So this we can see the summary of maturity analysis of the outstanding derivative financial asset and liabilities of the group in the next slide. So this is the detail of interest rate swap. So we can see as at 31st December 2019, there is a USD amounted 248,400. So for the less than 1 year, the fair value asset or liability amount 3,555. For 1 to 2 years, the amount is 4,184. As at 31st December 2018, the USD amounted for the contract value is 460,295, and the fair value asset and liability for less than 1 year 782, 1 to 2 years 1,658, 2 to 5 years 1,947. Okay, this is the forward foreign currency exchange contract notes, which we can see as at 31st December 2019, the USD contract value is 94,939, less than 1 year is 1,141. As at 31st December 2018, the USD amount 208,454, less than 1 year is 1,068. So for the commodity future contract, there is as at 31st December 2019, there is a less than 1 year contract value for 203,961, and for the fair value asset and liability 29,969. As at 31st December 2018, the group is less than 1 year 32,797, and for the fair value asset or liability amounted 367.
Okay, now is the presentation of hedge accounting in consumer product and services industries, which is a Dutch lady milk industry Berhad. Okay, from the slide we can see their statement of financial position, which is the derivative financial liabilities for 2019 is 1,887 million, while for 2018, 1,059 million. Okay, now is the notes to the financial statement for the information from previous slide, which is derivative financial asset or liabilities. Okay, what we can see now is the derivative held for trading at fair value through profit or loss forward exchange contract. Okay, we can see their amount for 2019 and 2018. Okay. Forward exchange contract are used to manage the foreign currency exposure arising from the company's payables denominated in currency other than the functional currency of the company. All of the forward exchange contract have maturities of less than 1 year after the end of the reporting period.
Okay, next, the statement of financial position. As we can see here, that on the net current asset, at the derivative financial asset, on notes 18, we can see that on 2018, for the group, it's cost 569,000 ringgit Malaysia, and in 2017 is 355 ringgit Malaysia, 355,000 ringgit Malaysia, which is, we can see that it increased in 2019. Also in the liabilities, non-current liabilities, we also can see this derivative financial liabilities is one of the item of the hedge items. Also note 18, which is 301 on 2018 and 2017 1447. Okay, we goes to notes 18. Okay, for the 18, it's use the interest rate swaps. Interest rate swaps are used to achieve an appropriate fair value change exposure within the group. The group enter into interest rate swap to hedge the fair value risk in relation to the fixed interest rates of the Islamic medium-term notes, as disclosed in note 20, which national principal amount of 750.0 million ringgit Malaysia. The interest rate swaps entitle the group to receive interest semi-annually at fixed rates ranging from 4% to 5% per annum, and in return pay interest quarterly at Kuala Lumpur interbank offer rates CLIBOR plus a spread with a weighted average rate of 4% in 2017 also 4%. The swap mature at varying dates based on the maturity of different tranches of the IMTN. During the financial year, the group recognized a net gain 0.6 million ringgit Malaysia, and on 2017 net gain of 0.5 million ringgit Malaysia arising from fair value changes attributable to changes in the market interest rate. So 80.2 foreign currency forward contract. So it used the forward contract. As we can see, the contract value in foreign currency USD on 2018 it cost 8,182, and for 2017 is 40,000. National value for 2008 34,171, and 27 is 58,228. And the fair value also for 2018 is smaller than 2017, which is 33870, and for 2017 56781. And the liability 2017 have higher liability compared to 2018. So the group used foreign currency forward contract to minimize its exposure to foreign currency risk as a result of transaction denominated in currency other than its functional currency, arising from the normal business activity. Foreign currency forward contracts are used to hedge certain payable denominated in USD for the firm. Commitment existed at the reporting date, extending to January and February 2009. During the financial year, the group recognized a loss 0.3 million ringgit Malaysia, and 2017 lost about 1.4 million ringgit Malaysia, arising from fair value changes between foreign exchange spot and forward contract. The foreign currency forward contract and interest rates are not designated as cash flow. Foreign currency forward contract and interest rate are not designated as cash flow hedging and are entered into for periods consistent with foreign currency exposure and fair value changes exposure. Any gain or loss arising from changes in the fair value of the derivative and recognized directly in profit or loss. The method and assumption applied in determining the fair value of the derivative above disclosure. So this means when we use the forward contract, it can reduce the risk. That's the benefit of the hedge accounting. So next. Okay. This is from article I chose the hedge accounting and impact on the financial market. So the issue is in Vietnam, where the Vietnam Chambers of the Commerce of Industry (VCCI) and the World Bank (WB) in 2011, which is Vietnam had 622,977 entities, in which 79,014 entities were bankrupted. Financial market of Vietnam, or a country with similar economy, have not also because most of the financial market of Vietnam and also the similar country with Vietnam not apply the hedge accounting to their hedge activity. This is because the language of the standard the language difference lead to their limited understanding about the content and the method of the international accounting standard. So the drafted guideline content are also unclear and irrelevant, that lead the entity the particular application of this circular face many difficulty. So the finding from this issue, they find the alternative by using of derivative financial instrument for financial hedge and their effect to minimize the financial risk of the entity and bankrupt entity, as well as their impact on financial market through decision of investor and managers, because their decisions are based on analysis result of financial items, financial statement, hedge accounting that are concerned with bankruptcy, financial risk and economic decline. The hedge accounting has been applied to the US economy for a long time, and it has minimized the financial risk. At the same time, it has played an important role in promoting the economic development, and the entity has applied hedge accounting to successfully prevent the financial risk. And to prevent the financial risk and found out the volatility of the cash flow and risk exposure in connection with interest rate, foreign exchange rates, and significant decrease of commodity price. And the last one is the firm should be use derivative instrument to minimize the risk. And next article, accounting of derivative instrument and the hedging activity. This issue is about to investigate the reasons behind the plethora of amendment of the FASB accounting pronouncement of financial instrument from 2002 to 2008. Next is to investigate the extent to which the 30 company that comprise the Dow Jones Industrial Average complied with the new qualitative and quantitative disclosure requirement for derivative financial instrument of SFAS number 161. And also to determine whether company comply with qualitative requirement of the SFAS number 161 to disclose their objective for holding or issuing derivative financial instrument and their risk management policy, as well as a description of the item being hedged. And lastly is treatment of the gain or loss resulting from the changes of the derivative carry value to fair value, since all derivatives are reported on the balance sheet at fair value, and fair value can change for the period to period. So the finding, we can say that the most company fail with the requirement of the SFAS number 161 to disclose the requirement information about cash flow hedge, net investment in foreign operation, and fair value hedge. The FASB issue SFAS number 161 to enhance derivatives disclosure to enable user of financial statement to evaluate the success and significance of derivative instrument and hedge transaction of an entity financial statement. Company might need additional time to implement the standard. And lastly, to disclose the income statement from the impact of opposed changes in price, interest rate, or currency exchange rates. Company exercise derivative for hedge would like to use an accounting approach. So next, okay, summary from this hedge accounting, which is 10 point to take home note about hedge accounting. First, strategy to eliminate or reduce their risk exposure. Second, to represent in the financial statement the effect of risk management activity that use financial instrument to manage exposure arising from particular risk that could affect profit or loss or other comprehensive income. Next is technique that modify the normal basis for recognized gain or loss or revenue and expense on associated hedging instrument and hedge item, so that both are recognized in P&L or OCI in the same accounting period. Next, eliminate or reduce volatility. Have hedge, which is they have two hedge item and hedge instrument, and have three type of hedge accounting, which is fair value, cash flow, and net investment for foreign currency, foreign. And the hedge instrument is measured at fair value and recognized in P&L. Future cash flow can also relate to forecast sale or purchase in foreign currency. And hedging effectiveness require, for example, economic relationship exists. So that's all from us. Thank you. Bye.